Asia Pacific real estate private credit is booming. Knight Frank forecasts up to 110 billion US dollars in new private credit over the next 3 years, with Australia set to drive nearly half of this. To discuss this today, we are joined by Knight Frank's Simon Matthews and Savills Neil Brooks. Gentlemen, thank you both for joining us today. What conditions could push growth of real estate private credit?
On the regulatory side, banks globally are operating under much tighter capital rules following Basel III and Basel IV, which has made them certainly more cautious around development lending, higher leverage deals, and instead we're now seeing them focus their lending appetite on more core stabilized assets. This has created very clear funding gaps, particularly for developers and investors with more complex or time-sensitive requirements. At the same time, we're also seeing strong investor demand for private credit as an asset class, especially as we are in a higher for longer interest rate environment where predictable asset-backed income is highly attractive. Certainly, we're seeing family offices and private wealth, particularly in APAC hubs such as Singapore and Hong Kong, looking to increase their allocations in credit as a whole as they look to maintain capital preservation.
Growth in real estate private credit is really being driven by a structural retreat of the traditional banks rather than a short-term cyclical change. So we're seeing regulatory changes under Basel III and IV making real estate lending more capital intensive, and that's pushing banks away from the more complex development and value-added loans. So that means at the same time as higher for longer interest rates having reset yields, we're seeing private credit becoming more attractive for investors seeking income and downside protection. Add to that a growing refinance wall, so loans that were written at peak valuations now coming to you, and we've got a clear gap where private credit with its speed, flexibility and bespoke structuring is uniquely positioned to step in.
Why is Australia expected to account for nearly 50% of the next growth wave, in your opinion?
Well, Australia combines three things that private credit capital values most, and that's scale, transparency, and credit protection. So the major domestic banks have structurally reduced their exposure to commercial real estate, and that's created a large funding gap that non-bank lenders are moving in to fill. And at the same time, we're seeing Australia, it's got a really highly transparent legal system compared to the rest of APAC, and that is with very reliable enforcement. So it makes it really attractive for offshore capital looking to deploy in APAC to come into Australia. Then you layer in an acute housing supply pressure and deep domestic capital from the superannuation and private wealth looking to get into private credit. And Australia really stands out as the most mature and scalable market within Asia Pacific.
While Australian banks remain active and are highly competitive in their market for lower risk, stabilized assets, they are constrained in what type of lending products they're able to offer in development, value add, and higher leverage scenarios. This again has created a clear and consistent rule for private credit lenders to step into the market. In particular, in Australia, a very large segment of this is the build to sell residential market, where developers will often look to limit the number of pre-sale requirements they have in order to allow them to capture rising values over the construction period of their schemes. Australia also benefits from a very transparent legal and regulatory framework, very strong creditor protections, and a reliable enforcement. All of these factors give both domestic and overseas investors a high level of confidence investing into credit in this market. And lastly, as transaction volumes continue to recover in Australia and development pipelines are re-established, it is Australia's depth, liquidity, and institutional maturity that will make it a natural focal point for private credit growth in Asia Pacific.
Which property segments offer the strongest risk-adjusted opportunities in the future?
I think from a sector perspective, the strongest risk-adjusted opportunities will tend to sit where demand fundamentals are resilient, but it's the access to traditional bank financing that is most constrained. I think a key example is probably the living sectors, so including build-to-sell residential development, build-to-rent, multifamily and co-living, particularly in markets such as Australia, India and Korea, where we are seeing a very structural demand-supply imbalance. I think another key sector to consider is logistics, alongside selected new economy assets such as data centers, which are both very attractive given their long-term demand drivers and suitability for well-structured asset-backed lending. I think in more stress markets, such as Hong Kong, we're seeing opportunities emerging through a degree of distress or discounted refinancings, particularly in the residential market and for strata commercial assets where liquidity supports repayment.
So going forward, I think the risk-adjusted opportunities are really going to be around the sectors where there's really strong structural demand and constrained supply. In particular, living sectors, so the build-to-rent sector and student accommodation in Australia, multifamily in Japan also, they offer really defensive income streams with long-term growth drivers. The migration story in Australia is really interesting. That's certainly driving huge demand for housing. The other area is data centers and digital infrastructure. So the AI boom and the demand for cloud has led to severe supply shortages in markets like Sydney, also Tokyo, Seoul. And then the other areas where we've seen big repricing, in particular Australian retail. So that really offers attractive income-led opportunities where fundamentals remain strong. I think that's where we're going to see private credit being deployed the most.
Well, thanks to both you gentlemen for joining us today. Some fabulous insights, Simon and Neil.
Thanks for having me.
Thank you, Simon.
Once again, our guests were Simon Matthews, Director of Capital Advisory for Global Capital Markets at Knight Frank, and Neil Brooks, Executive Managing Director and Head of Asia Pacific Capital Market at Savills. For more news, please visit realestateasia.com.